Let me start like this. There are basically two versions of being 22 in America. One version keeps money in checking, refreshes the balance, waits for real income, and hopes future them figures it out. The other version lets tiny amounts of money quietly buy pieces of the economy while they're asleep. Neither version feels dramatic in the moment, but 10 years later, completely different lives. That's the fork. And micro-investing sits right at that fork. Not as advice, as an option set. Because here's the truth nobody likes admitting. Most people don't choose to ignore investing. They just never see a version that fits how they actually behave. So let's lay out the behaviours first. Not morals, not discipline, behaviour. Some people hate thinking about money. Some people want control, but not stress. Some people want maximum freedom and minimum rules. Micro-investing exists because all three types exist. So imagine three parallel timelines. In one timeline, money moves without permission. This is the I don't want to notice it lane. This is where Acorns lives. In that timeline, purchases round themselves up. Spare change leaks into investments. No decisions, no opinions, no strategy meetings with yourself at midnight. The upside? Consistency without effort. The downside? A monthly fee and less customization. That timeline works best if the goal isn't optimization, it's inevitability. In another timeline, there's curiosity but not chaos. That's the stash line. Here, money still moves in small chunks, but you see where it's going. You choose themes, ETFs, fractions of companies. It feels educational, still low stakes, still not intense. The upside, learning plus investing at the same time. The downside, more choices than strictly necessary, which can slow people down if they overthink. And then there's the third timeline. This one has no guardrails. This is Robinhood, Fidelity, Charles Schwab territory. This lane has zero commissions, fractional shares and full access. Nothing stops you, nothing saves you either. The upside? Lowest cost, maximum flexibility. The downside? Your habits matter a lot more. Same destination, different friction. And here's the part that matters more than the platform. All three timelines are powered by the same invisible force: time. That's the only ingredient you can't add later, and Gen Z has more of it than anyone. Which is why micro-investing works best now, not because of income, but because starting early turns small inputs into unfair outcomes. Let's zoom out for a second. There's this idea floating around that investing only counts if it's big, aggressive, or impressive. That idea ruins people, because compounding doesn't care about aesthetics, it cares about duration. $10 invested at 20 doesn't look serious. $10 invested for 40 years is devastatingly effective. That's why micro-investing feels boring at first and dangerous later. And here's where psychology kicks in. Big investments trigger fear. Small investments sneak past it. A $1,000 drop feels like a crisis. A $12 drop feels like background noise. And background noise is where consistency survives. This is why dollar cost averaging isn't just a math concept, it's a behavioural hack. Money goes in whether the market is up, down or chaotic. No decisions, no timing guilt, no panic, just accumulation. Now in all three timelines, there's another quiet fork that shows up. What the money actually buys. This is where people think complexity equals intelligence and lose years because of it. But there are really only three core asset lanes at the beginning. One lane buys the S&P 500. 500 are the biggest companies in America. Tech, healthcare, finance, consumer, all of it. Another lane buys the total US market. Large companies, small companies, everything in between. And the third lane hands control to a target date fund. You pick a year, risk adjusts automatically as time passes. All three assume the same belief, that the US economy will be larger in 40, 50 years than it is today. If that belief turns out false, retirement has bigger problems anyway. And here's the interesting part. Once money's invested this way, passively, automatically, consistently, something weird happens. People stop asking, is now a good time? Because time is already doing the work.
That's the moment investing stops feeling like a task and starts feeling like infrastructure, which is exactly why micro-investing changes how people think before it changes how much they earn. Now let's talk scale without hype. Micro-investing doesn't turn into wealth because of insane returns. It turns into wealth because of math that doesn't reset. $10 a week becomes $40 a month. $40 a month becomes $480 a year. That repeats while income rises. And here's the part nobody announces. Most people don't increase contributions because they plan to. They increase them because the habit already exists. Once investing's normal, raises don't disappear. They redirect. That's the quiet snowball. Now there's another optional lane that exists parallel to all of this. It's not required, it's not urgent, but it's powerful. That lane is the Roth IRA. Same platforms, different tax treatment. Money goes in after tax, growth comes out tax-free. That's not a hack, that's the government incentivizing long-term behavior. The Roth lane matters most when time is on your side, which is exactly when Gen Z is standing at the door. And again, this isn't about maxing anything out. It's about starting the clock in a container that doesn't tax future growth. Small money, long runway. That's the theme. Now somewhere around here, most people start mentally objecting. What if the market crashes? What if I need the money? What if I mess it up? And those are all valid timelines too. In one timeline, the market drops and automated contributions buy cheaper assets. In another timeline, contributions pause temporarily without dismantling the system. In another timeline, nothing changes because micro-investing was never the emergency fund. That's the flexibility people miss. Micro-investing doesn't trap you. It doesn't lock you into heroics. It just tilts probability slightly over and over again until probability starts looking like certainty. And here's where it gets subtle. The real advantage isn't the money. It's that investing stops being something future you will do. It becomes something that's already happening. And once that switch flips, comparison loses power because you're no longer watching people talk about money, you're participating in it, quietly. Which brings me back to the fork. There's no single correct line here, there's just friction tolerance. Some people need invisibility, some people need guidance, some people need autonomy. Micro-investing works because it offers all three without demanding perfection. And the craziest part? None of these paths feel dramatic while you're on them. They only feel obvious in hindsight, which is how most financial wins actually work. Not loud, not urgent, just early. So if someone was standing at the edge of this decision, not asking what's right, but what's livable, the options are already there. Invisible money, guided money, self-directed money. Same market, same math, different friction. And once one of those paths starts running, something important happens. You stop waiting. And that, more than anything, is where the advantage shows up.